Hi, welcome to the fifth review session. Well, this review session is on the topics capital and revenue receipts and expenditure and contingent assets and liabilities. So before I start reviewing the questions, I'll give you a brief about these topics. We'll start with I'll give you an introduction on the topic capital and revenue expenditure, and why it is important to distinguish between capital expenditure and revenue expenditure. Right? See, expenditure can be classified broadly into two types: capital expenditure and revenue expenditure. Okay, capital expenditure is the expenditure that is incurred in order to purchase fixed assets. Not just purchase fixed assets. Suppose any expenditure is incurred on an existing fixed asset which is going to improve its efficiency. That expenditure is also capital expenditure. What is the accounting treatment for this capital expenditure? Such an expenditure will appear in the balance sheet as an asset. Revenue expenditure is an expenditure that is incurred with respect to the day-to-day operating activities, or an expenditure which is incurred on an asset in order to maintain the earning capacity of an asset. For example, repairs. Example, salaries, rent, whitewashing of a building. So all these are expenses which are incurred in order to either run the day-to-day operations, or expenses that are incurred in order to maintain the existing earning capacity of an asset. Such expenses are called revenue expenses, and they find their place in the profit and loss account. It's important to distinguish between capital expenditure and revenue expenditure, because if we treat a revenue expenditure as a capital expenditure, we will be understating the profits and will be overstating the asset position. For example, if repairs is debited to machinery account, then the profit is going to be overstated and the asset position is also going to be overstated. Okay, and similarly, if we treat a capital expenditure as a revenue expenditure, then the profit is going to be understated and the asset position is also going to be understated. For example, if machinery purchased is going to be debited to repairs account or some other nominal account, then in that case profit will be understated and the asset position is also going to be understated. So that is why it is important to distinguish between capital expenditure and revenue expenditure. So when an asset is purchased or when a significant improvement is made to an asset, so we place that expenditure in the balance sheet and we depreciate the asset. Depreciation is a revenue expenditure. So basically we are distributing the cost of the asset over the useful life of the asset. So with that introduction, we will get into the various questions. The first question is: insurance and freight on machinery purchased is what expenditure? So we have to keep in mind that capital expenditure does not mean just the purchase cost of machinery. All the expenses that are incurred in order to bring the machinery to its intended place and use. So that all expenditure that is incurred in order to make the machinery available for use is called capital expenditure. So insurance and freight on machinery purchased is capital expenditure. So for example, if the machinery cost, the basic cost of the machinery is say 1 lakh rupees, and the expense incurred on insurance and freight is say 30,000 rupees, then the cost of the machinery that is to appear in the balance sheet is 1,30,000 rupees. The accounting entry that we will pass will be machinery account debit to cash. Will not be debiting insurance account or freight account, because we are not treating it as a revenue expenditure, we are treating it as part of the cost of the machinery, and hence we'll be debiting machinery account, and as I told you in this example, 1,30,000 will be subject to depreciation year after year. So the answer to the first question is A, capital expenditure. Customs duty on imported machinery. Right, so when we import machinery, we have to pay the customs duty in order to clear it from the airport. So unless we pay the customs duty, we will not be able to bring the machinery to its we cannot make it available for our intended use, and hence customs duty is capital expenditure, so it has to be added to the cost of the machinery. So answer is A. Expenses incurred on trial run. These expenses are capital expenditure. This will be added along with the cost of the machinery. So answer is A. Next, cost of a second-hand machinery purchased. So this is quite a straightforward question. So it doesn't matter whether the machinery is a first-hand machinery or a second-hand machinery or a third-hand machinery. It is an asset to the person who is purchasing it. So it is a capital expenditure for him. So the basic cost of purchasing a second-hand machinery is capital expenditure. So when he purchases a second-hand machinery, the entry that he will pass is machinery account debit to cash, and it is going to be capitalized as an asset. Next, question number 5. Money spent to reduce working expenses. Okay. So as I told you earlier, capital expenditure does not mean only purchase of a fixed asset. Okay. So suppose some money is expended on the asset so as to improve its earning capacity, or earning capacity can improve, or its efficiency can improve, so that the expenses that is to be incurred on it reduces. So either which ways, the company or the business is going to benefit by on a longer term by the money that has been spent on the machinery. So the money that a business spends in order to reduce working expenses is capital expenditure. Overhauling expenses for the engine of a motor car to get better fuel efficiency. Right. See, for example, let us take the example of a car which gives us a mileage of, say, about 11 kilometers per liter. Right. And so you incur certain expenses in order to either replace the engine, or you make some serious modifications to the engine so that the car starts giving you, say, 13 kilometers per liter, or 14 kilometers per liter, which is going to benefit you in terms of lower petrol cost. Right. So such expenses that you incur in order to get better fuel efficiency, so there is enduring benefit that is arising out of this expenditure, and it is enhancing its performance, it's enhancing its efficiency, which is going to lead to better or rather, it is going to benefit the entity in future. Such expenses are capital expenditure, and so this is to be treated as a capital expenditure. Legal expenses to acquire an asset. For example, when we purchase land, so we need to get the title cleared, and we might need to get the services of a lawyer. So such expenses that are incurred in order to acquire an asset are capital expenditure, and it is to be added to the cost of the asset. Amount spent for the construction of temporary huts for storing building material while constructing a building is okay. So I think this is a common sight. We find small huts or small temporary constructions outside the construction site, where either the workers live or they store their building material. So this construction of temporary huts is absolutely essential for the construction of the building, right? And hence the amount that is spent for construction of these temporary huts is capital expenditure, and it will be added to the cost of the building. Okay, suppose we are constructing a building for about 1 crore, then whatever we spent on constructing these temporary huts will be added to the cost of that building, right? And it will be depreciated accordingly. Right. Amount spent on demolition of building to construct a bigger building on the same site. Right. See, unless we demolish an existing building, it is not possible to construct a new building. Okay, so the amount that is spent on demolishing the existing building in order to clear the place, level the ground, all the expenditure that is incurred on that is capital expenditure. It is going to get added to the cost of the new building that is going to come up. So such expenditure is necessary in order to make the new asset come into existence. Okay, so such expenditure is capital expenditure. Purchase of goodwill. Yeah, see, capital expenditure need not be purchase of tangible assets only. It can be purchase of intangible assets like brands, trademarks, licenses, goodwill. So all this is capital expenditure. So whether it is tangible fixed assets or intangible fixed assets, the money that is spent on acquiring an asset which is a capital in nature is capital expenditure. So purchase of goodwill is capital expenditure. Purchase of technical know-how, yes, purchase of technical know-how is an intangible fixed asset, and so it is also capital expenditure. Right. Now we have a problem to work out. Second-hand machine was purchased for rupees 1 lakh through a broker who charged 1%. It was brought to factory after incurring transportation cost of rupees 2000, and then it was repaired at a cost of rupees 3000, and then installed at a cost of rupees 4000, and rupees 5000 was spent on trial run production. The commercial production began and continued up to 11 months, at the end of which the machine was repaired at a cost of rupees 6000. What is the amount that is to be debited to machinery account? Right, so we are given various expenses that the business has incurred in relation to the purchase of the second hand machine, and we are required to find out what is the amount that is to be capitalized, that is what is the amount that is to be treated as a capital expenditure, or what is the amount that is to be debited to the machinery account. Okay, so the basic purchase cost of the second hand machine is rupees 1 lakh, right? So definitely that is to be capitalized. Secondly, it says that a broker charged 1%. Okay, so the commission that you incur in order to acquire the asset is part of cost of the asset. Okay, so it's not just the basic cost as I told you, but all incidental expenses that are incurred in order to acquire the asset and to bring the asset to its intended to its place of intended use, and in order to make it available for the intended use, are all to be added along with the cost of the asset. So the basic purchase price is rupees 1 lakh. The broker charged 1%, so broker commission is 1% of 1 lakh, which is 1000. Right. The next expenditure is it was brought to factory after incurring transportation cost of 2000. So the expenditure that is incurred in order to bring the machinery to the place where it is to be used is to be added to the cost of the machinery. So we will add 2000 to 1 lakh 1000. Right. So 1 lakh is the basic cost, 1000 is the brokerage. So now it becomes 1 lakh 1000, to which we add 2000, which is the transportation cost. So now the cost becomes 1 lakh 3000. And then see, we must keep in mind that this is a second hand machine, right? So in order to make it available for use, we have to incur some repairs. So such repairs which are necessary in order to make the machine available for use is capital expenditure. Okay, so this 3000 rupees that has been incurred in order to repair the machinery will get added to this 1 lakh 3000 that we arrived at so far. So now we have arrived at the cost as 1 lakh 6000 rupees. Then installation charges was 4000. Installation charges is also to be added as part of the cost of machinery, so it becomes lakh and 10,000. And as we saw earlier, the expenses that are incurred on a trial run production are also to be included with the cost of the asset. So now the cost of the asset, or the amount that is to be debited to the machinery account, is 5000 rupees. So I'll just work it out for you. Okay, so the basic cost of the asset is 1 lakh, okay, on which brokerage is 1000. Then we are incurring transportation charges to bring the asset to the premises, that is also to be added to the cost of the asset, after which some repair costs are incurred, which is 3000, and trial run expenses on trial run is 4000. Okay, so lakh and 15,000 rupees, right? No, sorry, there is one more 5,000 that is incurred. Let me just take a look at that. Okay, installation cost is 4,000 rupees. I forgot the installation cost. So let's add, so this is lakh and 10, sorry, trial run is 5,000. We'll just change it to 5. So this becomes lakh and 16, lakh and 11,000 plus some 4,000 rupees on installation. So it becomes lakh and 15,000 rupees. So the total cost of the machinery is lakh and 15,000 rupees. Alright, so let's look at problem number 13. A second-hand car is purchased for rupees 20,000. Amount of 3,000 is spent on its repairs. Rupees 1,000 is incurred to get the car registered in owner's name, and 2,000 is paid as dealer's commission. Okay, so what is the amount that is to be debited to car account? So all the expenses that have been incurred are to be included in the cost of the car. So the basic cost is 20,000. 3,000 is spent on its repairs. As I told you, it's a second-hand car, so unless you spend some money on its repairs, you will not be able to put it to its intended use. And so 23,000 it becomes, and you have to the money that is spent in order to get the car registered in the owner's name is to be added to the cost. So now it becomes 24,000, and dealer commission is an incidental expense which we have to incur in order to acquire the asset, right? So the amount that is to be debited to the car account is 26,000. Okay, cost of rupees 1,000 incurred on dismantling a machine that's worn out is revenue expenditure. Okay, so the machine is worn out, it is just going to be scrapped, and so the money that you spend on dismantling a machine that's completely worn out is revenue expenditure. Next, annual maintenance fee of a machine. Okay, so annual maintenance is that whenever we buy any asset, an annual maintenance contract comes along with the asset, which we can accept, or we need not get into an annual maintenance contract. But the purpose of this annual maintenance contract is that the machine will be repaired regularly. The machine or the asset will be repaired regularly so that it works without any hassles and its present earning capacity is maintained. Okay, so since it is an expenditure which is incurred in order to maintain the existing running condition of the asset, it is a revenue expenditure. Legal expenses incurred to defend a suit claiming that firm's factory site belongs to the plaintiff. Okay, so legal expenses that are incurred to defend a suit, that is, you own a land or you own a particular, you own a factory site. Somebody tells that the factory site actually belongs to them and not to the plaintiff. Then you engage a lawyer and you incur certain expenses for the lawyer, and the expenses that you incur to defend your title to the factory site is revenue expenditure. Annual renewal fee of a license for next year. Okay, so here is a case where you are paying the renewal fee for the next year. The current year itself. So it is a prepaid expenditure. It is a revenue expenditure, but it is prepaid, right? So it will be prepaid expenses, as we know, will appear as a current asset in our balance sheet. So annual renewal fee of license for next year is prepaid expenditure. Fines imposed is revenue expenditure, so it cannot qualify as a capital expenditure because it is not increasing the earning capacity of an asset, nor is it related to purchase of a fixed asset. So fines imposed is revenue expenditure. Okay, free gift to customers. Free gift to customers. I think we can just ignore the rest of the question. Free gift to customers. Yeah, it's some kind of an advertisement expenditure, and hence it is revenue. Legal expenses to recover dues from customer. Right. So suppose your debtors don't pay you on time, and you have to take the legal recourse to collect the dues from the debtors. Such expenses is revenue expenditure. Right. Annual fire insurance of building of rupees 12,000 paid on 1st Jan 2006 during accounting year ending on 31st March 2006. Okay, so here you've paid your insurance premium on 1st January 2006. The contract will run from 1st January 2006 to 31st January 2000 to 31st December 2006, but your accounting year is ending on 31/3/2006. So the expenditure that pertains to the year 31/3/2006 is for 3 months, that is Jan, Feb and March, and of this 12,000, the expenditure that pertains for 3 months is rupees 3,000, and the remaining 9,000 will be shown as a prepaid expenditure in the balance sheet as at 31st March 2006. So the answer to this question is B. Festival advance to employees. Okay, so festival advance to employees is some kind of a loan that is given by the business to its employees just before a festival, so that they can spend for the festival. And such advances, it's strictly not an expenditure because it will be recovered later from their salaries, and hence it is classified as loans and advances in the balance sheet. Advance to suppliers of goods. This is where even before you purchase goods from the suppliers, you pay the supplier in advance. So this is not an expenditure. It's some kind of an advance. It's some kind of a loans and advances. It will be classified as loans and advances in the balance sheet on the asset side, obviously. So the answer is D. Right. Capital introduced is okay. So capital introduced is a capital receipt, right? Because it is relating, it does not relate to the it's not an operating activity, it is a financing activity of the business, because capital is brought into the business in order to finance the purchase of various assets of the business. So capital introduced is a capital receipt. Similarly, loans is a source of finance. It is not an operating activity, and hence loans raised is capital receipt. Subsidy received from government for plot of land. Okay, so buying a plot of land is capital expenditure. So the subsidy that you get from the government in order to make a capital expenditure is a capital receipt. But if the business is receiving a subsidy for it's as in the form of a general grant, okay, let us say in order to meet its day-to-day expenses, then that subsidy will be a revenue receipt, but this is a capital receipt. Premium received on issue of shares. Yes, issue of shares is a capital receipt, and so a premium received on issue of shares is also a capital receipt. Revenue from sale of products on credit ordinarily is reported as part of earnings in the period in which, okay, right, so here we are talking about revenue recognition. When do we recognize revenue from sale of products? Okay, so the revenue is recognized in the period in which the sale is made and not in the period in which the cash is collected. Right, so when we make a credit sale, we record for it immediately. We do not wait until the time we get the money from the debtors to show it as a revenue. So answer is A, when the sale is made. Cash received from debtors is a revenue receipt because it is part of the normal operating activities of the business. You make a sale, that is the operating activity, and when a sale is made on credit, we get money against the sale from our debtors eventually, and so such money that is received from debtors is revenue receipt. Bills receivable collected, this is also revenue receipt because a bills receivable is or a bill is accepted by our debtor when a credit sale is made, and so on the maturity date when the debtor honors the bill, it is a revenue receipt. Insurance claim for stock damaged by fire is a revenue receipt because stock relates to the operating activities of the business, and so the insurance claim that is received for stock damaged by fire is a revenue receipt. Bad debts recovered. Bad debts is again related to debtors. Debtors which we think are irrecoverable will be written off, and but in case we recover some money against the debts that were earlier written off. So since collection from debtors is revenue receipt, similarly bad debts, the debts that were written off as bad but you are able to recover something from them now, is also a revenue receipt. Loss on sale of machine is a revenue loss. It is it's not a capital loss. So a loss on sale of machine is a revenue loss. Answer is B. Right. Okay. So now we come to the next topic. This is with respect to provisions, contingent assets and contingent liabilities. So question number 34, it says in the financial statements, provision is recognized, not recognized, adjusted, none of these. Okay, so in the financial statements, provision is recognized. Provision for depreciation, provision for bad debts, okay, so provision for warranties. So these are provisions. A provision is generally a liability which is of an uncertain timing and amount. Okay, so based on certain estimates, provisions are made, and if we are not able to make a reliable estimate of the provision, it is advisable not to recognize the provision in the books but only to make a disclosure of it. Okay, so in the financial statements, provision is recognized, and in fact a detailed note about this provision is supplied in the notes to the accounts. Next, if a reliable estimate of probable outflow of resources to settle a present obligation cannot be made. Okay, see, for example, let us say that there is a suit against a company. Somebody has filed a suit against the company, and the proceedings are happening in the court of law, but it is uncertain. Okay, it is uncertain as to who will win the case. Okay, so even if it seems likely that the company is likely to lose the case, but we are not able to make a reliable estimate of the damages that the company will have to make good in case there is in case the other person wins the case, then such an obligation is a contingent liability. So a contingent liability will not be recognized in the balance sheet. So this is a liability which is contingent upon the happening or non-happening of certain uncertain future events which are not wholly within the control of the enterprise. Okay, so contingent liability will only be disclosed in the balance sheet. Examples are like arrears of preference dividend, right? So calls that have not yet been made. Okay, and similarly, in case of a suit where the decision is pending, or where you are not able to make a reasonable estimate of the damage that you are likely to pay in case you lose the case. So such are examples of contingent liabilities, and they are only supposed to be disclosed because you are not able to, though there is a present obligation, if you're not able to make a reliable estimate of how much is going to be the probable outflow of resources, you cannot show it as a liability. Okay, because the definition of a liability is different. Okay, a liability is a present obligation, the settlement of which is likely to result, or settlement of which requires outflow of future economic benefits or outflow of economic resources. So here there is a present obligation, but you're not able to make a reliable estimate of how much you will have to spend in future in order to settle that obligation. Such a liability is a contingent liability. Okay, next, in the case of dash, either outflow of resources to settle the obligation is not probable, or the amount expected to be paid to settle the liability cannot be measured with sufficient reliability. Okay, so this is the definition of a contingent liability. Okay, so suppose there is a situation where you know that the chance of your spending in order to settle the obligation is not probable. Probable means the chance is less than 50%. Okay, then in that case you don't have to show it as a liability, it becomes a contingent liability. The other case is where there is a present obligation, but you are not able to measure the amount that you will have to pay in future in order to settle that present obligation. Okay, so that again is a contingent liability. So answer is C. Question number 37. If a reliable estimate of probable outflow of resources to settle a possible obligation cannot be made. Okay, so it is, see, this is where a reliable estimate of probable outflow of resources to settle a possible obligation cannot be made. It is to be disclosed as a contingent liability. Yeah, we come to the last question. If an inflow of economic benefits is probable, okay, then a contingent asset is disclosed where? Okay, so a contingent asset is where you expect certain inflow of economic benefits, but that is dependent upon the happening or non-happening of an uncertain future event, not wholly within the control of the enterprise. Now what does this mean? See, for example, suppose let us take that the company has filed a suit against another entity, and the company is very confident of winning the case, but the suit is still pending in the court of law. So we don't know what is going to be the decision. Though the company feels that it is going to win the case, this receipt of damages upon winning the case is contingent upon the decision that the court of law is going to give. So such an asset cannot be recorded in the books as a receivable because of the concept of prudence or the concept of conservatism, and this cannot be disclosed in the financial statements. This will be disclosed in the report of the approving authority. For example, in case of companies, the board of directors is the approving authority, and the annual report contains a section called the directors report, and that directors report will contain information about this contingent asset. So answer is P. Yeah, so with this we conclude today's review session. So in case you have doubts, you please feel free to get in touch with me through email. You can mail your queries at queries@greymatteracademics.com. So until next time, goodbye.